Imagine working every day of your life. Not occasionally. Not when it suits you. Every day. You set an alarm. You get up before you are ready. You commute. Or you clock in. Or you sit down and begin. You spend hours doing something that someone else needs done. And at the end of that week, or that month, a number appears. A deposit lands. A check arrives. That number represents your time, your effort, your presence. And for most people, that moment feels like the point of the whole arrangement. You worked. You got paid. Simple. But here's a question that almost nobody asks out loud. When exactly did that payment stop being entirely yours? Not in any dramatic sense. There was no single moment of obvious loss. No announcement. No event that people gathered to protest or even fully notice. Something much quieter happened instead. Something that moved slowly, across decades, through channels that looked official and reasonable and even helpful. And because it moved that way, gradually, institutionally, always with an explanation attached, most people never identified it as a shift at all. It simply became the way things were. Think about what a paycheck actually represents before any deduction touches it. It represents an agreement. An employer needed work done. A worker agreed to do it. A wage was set. That wage, in its original form, belongs entirely to the person who earned it. That is the foundation of the arrangement. Labor exchanged for compensation. Nothing in between. But somewhere along the way, something appeared in between. And then something else. And then more. Slowly, the journey from what was earned to what was actually received became longer, and involved more stops, and passed through more hands. Each stop had a name. Each stop had a justification. And each stop was presented not as a subtraction, but as a system working correctly. Deductions are perhaps the most visible part of this. Open any pay stub from the last several decades, and the structure is immediately clear. The top line shows what was earned. The lines below show what was taken. Taxes, of course. Federal, state, local, depending on where you live. Then social contributions. Health insurance premiums. Sometimes retirement fund deductions. Sometimes union fees. Sometimes other items with official names that most people read once and never question again. By the time the final number appears, the amount actually deposited or handed over, it is often significantly smaller than the top line, sometimes dramatically smaller. And this is where it becomes unclear, because most people, when they think about their income, think about the bottom number, the take-home amount. That has become the real wage in the minds of most workers. The top number, the gross amount, the actual value of the labor, feels like an accounting detail rather than the real figure. Which raises a quiet but significant question. When did workers stop thinking of their full earnings as theirs? And is that shift in thinking an accident, or did something cause it? At first, this seems like a straightforward administrative matter. Governments need funding. Systems need to be maintained. The money has to come from somewhere, and income is a logical source. This explanation is simple, and for many people it is entirely satisfying. Of course, some portion of wages goes to collective needs. That is how modern societies function. There is nothing particularly mysterious about taxation. But the question is not whether deductions exist. The question is how they expanded, and when, and through what process. Because if you trace the history, the picture is more complicated than the simple explanation suggests. What began as systems targeting specific groups or specific circumstances gradually broadened. Thresholds shifted. Categories expanded. New obligations were added alongside existing ones. And each addition came with its own reasoning, its own framing, its own sense of necessity. Taken individually, each step seemed manageable. Taken together, across a century of accumulation, the effect on what a working family actually kept from what it earned is substantial. There is also something worth noticing about the timing of major changes to these systems. Several of the most significant expansions in wage deductions and financial obligations did not happen during calm, stable periods when people had the time and freedom to examine and debate them carefully. They happened during crises, wartime, economic emergencies, periods when questioning the necessity of government action felt unpatriotic or irresponsible. Temporary measures introduced under urgent circumstances had a consistent tendency to remain long after the urgency passed. This pattern appears more than once across different countries and different eras. It doesn't fully make sense as pure coincidence, but what it actually means is not easy to state with certainty. Families across generations have felt this in practical terms, even when they could not describe it clearly. Older generations speak of times when a single income was enough to support a household, raise children, own a home, and still set something aside. That is not mythology or nostalgia distorting the past. The economic records support it. There were periods when the relationship between wages and cost of living looked meaningfully different than it does today. The gap between earning and keeping was narrower. The sense that work translated directly into security was more grounded in reality. Something shifted, and this is where the explanation becomes difficult, because the shift did not happen through any single policy or any single decision. It accumulated, layer by layer, obligation by layer. The distance between what was earned and what remained grew, and because each layer arrived separately, with its own justification, the accumulation was never presented as a whole. Nobody held up the complete picture and said, "Here is what has changed. Here is what your earnings now pass through before they reach you." Instead, each piece was introduced on its own terms, and people adapted, and the new reality became normal. This is perhaps the most important part of the question, not just what changed, but how it was absorbed, because most people did not fight these changes. Most people accepted them, not enthusiastically, perhaps, but without sustained resistance. And this raises a genuinely puzzling dimension to the whole thing. Why? If earnings were being progressively reduced, if the share of labor that workers actually kept was declining, why was that process so quiet? Why did it not produce more pushback? Some say the answer is simple. People were told these systems benefited them, and they believed it. Social Security deductions were savings for the future. Tax contributions funded services that everyone used. Insurance premiums protected against risk. These were not presented as losses. They were presented as investments, protections, collective goods. And many people, looking at what they received in return, concluded the exchange was fair. Others disagree. They point to the gap between what was promised and what was delivered. They look at retirement systems that required decades of contributions, but provided less security than advertised. They examine healthcare arrangements that took regular premiums, but still left families facing significant costs. They note that the services funded by tax contributions were not always distributed evenly, and that the people contributing the most as a proportion of their income were not always those who benefited most from what those contributions funded. But even setting aside the question of whether the exchange was fair, there's a more fundamental question sitting underneath all of this. It is about awareness, about perception, about the difference between a wage that someone earns and a wage that someone receives. When a worker agrees to a rate of pay, and then has a significant portion removed before it ever arrives, there's a gap between what was agreed and what was delivered. For most of history, people felt that gap immediately and directly. More recently, it has been structured in ways that make it less visible, less felt, less discussed. This is not a conspiracy. It is not necessarily even a deliberate design. It may simply be the accumulation of many separate decisions, each reasonable on its own, none of them planned with the total effect in mind. That is one possibility. But here is what cannot be easily dismissed. The numbers are documented. The history is recorded. The pattern of expansion, more obligations, more deductions, more distance between earned and received, is measurable across multiple countries and multiple decades. And the explanations offered for each individual piece of that pattern do not, when examined together, fully account for the overall direction. Something happened to the relationship between work and its reward. It happened slowly enough that most people never identified a turning point. It happened through systems legitimate enough that questioning them felt unusual, and it settled into a reality so familiar that most people today do not think of it as a condition that requires explanation at all. But perhaps it does. Perhaps the most important questions are the ones that feel too normal to ask. When exactly did that paycheck stop being fully yours? And does anyone have a complete, honest answer to that question? The numbers are there. The history is there. But the explanation of how it all happened, and why it happened this particular way, and who it ultimately served, that part remains, on careful examination, surprisingly unclear. Every system has an official story, a version of events that is taught, repeated, and generally accepted, an explanation that most people encounter early in life and rarely revisit. For the system of payroll deductions, for the entire structure of how wages are reduced before they reach workers, that official story exists too. It is clear, it is logical, and for a long time, most people found it entirely satisfying. The explanation goes like this. Societies grew, populations expanded, cities developed, and with that development came needs that individuals could not meet alone. Schools had to be built and staffed, roads had to be constructed and maintained, hospitals required equipment and personnel, emergency services needed funding, courts, administrative systems, infrastructure of every kind, all of it required consistent, reliable money to function, and that money had to come from somewhere reasonable and sustainable. Income taxation became the accepted answer to that question. If people were earning wages, then a portion of those wages could fund the collective systems that made earning possible in the first place. The logic was presented as circular in a productive way. You earn because society functions. Society functions because you contribute. Your contribution makes your earning possible. The system described itself as self-sustaining and mutually beneficial. And on the surface, that framing is not unreasonable. The method chosen to collect these contributions was the payroll deduction. Instead of asking workers to calculate and pay their full tax burden at the end of each year, which would require setting aside money, managing it carefully, and then surrendering a large sum all at once, the deduction system spread the collection across every pay period. Small amounts, taken regularly, before the worker ever handled the money. Employers were assigned the role of collecting these amounts and forwarding them to the appropriate government bodies. Workers received what remained after the collection was complete. At first, this seems like a genuinely practical arrangement. Spreading payments across a year reduces the burden of any single transaction. It makes government revenue more predictable and consistent. It reduces the risk of workers spending everything and having nothing left at tax time. The convenience framing was not invented. There's real logic behind it. But this is where it becomes unclear. Because convenience for whom, exactly, is a question worth asking. The system is certainly convenient for governments collecting revenue. Whether it is equally convenient for workers, or whether it primarily serves the interests of collection, is less obvious than the official explanation suggests. Beyond income taxes, the official story extends further. Social security systems were introduced across multiple countries during the 20th century, particularly following economic crises that left older populations without financial support. The framing was straightforward and appealing. Workers would contribute a portion of their wages throughout their working lives. Those contributions would be held and returned in retirement. It was presented as a form of enforced personal savings, a way of ensuring that people did not arrive at old age without resources, regardless of whether they had been disciplined savers throughout their lives. Health insurance contributions followed a similar logic. Medical costs can be unpredictable and large. A single serious illness or accident can destroy the finances of a family that was otherwise managing comfortably. Insurance pools that risk across many people, so that no single individual bears the full cost of misfortune alone. Pension contributions promise security in later years. Each deduction that appeared on a pay stub came with its own version of the story. Protection, security, collective benefit, long-term thinking. The overall picture that the official explanation paints is one of a fair exchange. Workers contribute a portion of what they earn. In return, they receive access to education, healthcare, roads, security, and retirement support. The state acts as the administrator of this exchange, collecting from those who work and distributing to those who need. The system is described as democratic in design, reflecting the choices of societies that decided collectively what kind of shared infrastructure they wanted to maintain. And for a significant portion of the 20th century, this explanation was not only accepted, it was largely supported by lived experience. In many countries, the decades following major conflicts saw real improvements in living standards. Wages rose in ways that kept pace with or exceeded inflation. Homeownership expanded. Access to education broadened. Healthcare became more available. The deduction seemed, during these periods to represent a genuine exchange. People paid in and received things of real value in return. The official story and the daily reality of many families appeared to match. But this is where the explanation starts to feel incomplete, because the decades of improvement were not evenly distributed, and they did not continue indefinitely. And when living standards began to stagnate for many working families, when wages stopped growing in the same relationship to costs, when the promises attached to various contributions began to seem less reliable, the official explanation did not update to account for what had changed. It continued presenting the same framework, even as the experience it was meant to describe began to diverge from what many families were actually living. There is also a question about how these systems were designed that the official story tends to move past quickly. The framing of payroll deductions as democratic, as the result of collective choices made by societies, requires that the design process itself was open, representative, and genuinely reflective of worker interests. But when you examine who was actually present in the rooms where these systems were constructed, the picture is more complicated. Economists, government administrators, banking advisors, and business representatives were consistently involved. Workers and ordinary families were represented unevenly, if at all. The systems that govern wages and deductions were not designed in a vacuum of pure public interest. Some researchers point to specific moments in this history as particularly significant. The introduction of automatic payroll withholding in the United States during the 1940s, for example, was not simply a bureaucratic efficiency measure. It was advocated for by specific individuals and institutions, promoted through particular arguments, and implemented in ways that had lasting effects on how workers perceived their own earnings. The same pattern, specific interests shaping the design of systems that were then presented as neutral and administrative, appears in other countries and other periods. This raises questions that the official story does not fully answer. If these systems were designed purely for the public good, why do the design histories show such consistent involvement from financial and governmental interests, rather than from those whose wages were being structured? At first, it seems normal that governments and financial experts would design financial systems. That is, in a straightforward sense, exactly what one might expect. But there is a problem. When the design of a system consistently reflects the interests of the parties doing the designing, when collection mechanisms are optimized for efficiency of extraction rather than for the experience of those being collected from, the claim that the system is balanced becomes harder to accept at face value. This does not mean the official explanation is wrong. It means it may be incomplete in important ways. The framing of these deductions as savings, protection, and collective investment carried real weight because it placed them in a positive category. A deduction that feels like a contribution toward your own future is psychologically different from one that feels like a simple reduction of your earnings. This distinction mattered in how these systems were introduced and how they were maintained. People were not told that a portion of their earnings would be permanently redirected. They were told that their future security was being built. Whether those two descriptions represent the same thing, or meaningfully different things, is a question that the official story tends not to examine carefully. What the official explanation ultimately provides is a coherent and reassuring account of why things are the way they are. It explains deductions as necessary. It frames them as beneficial. It positions the entire structure as a democratic achievement, the result of societies choosing to care for their members collectively. And none of these claims are entirely false. There are genuine public goods that are funded through these systems. There are real protections that exist because of collective contributions. But the official story has limits. It explains the purpose of the systems without fully examining their design. It describes the intended benefits without accounting for the gaps between intention and outcome. It presents the historical process as natural and inevitable without acknowledging the specific decisions, specific people, and specific interests that shaped it. And it has remained largely unchanged even as the experience of working families has shifted in ways that the original explanation no longer fully accounts for. This is not a reason to reject the official explanation entirely, but it is a reason to look more carefully, because a story that explains everything smoothly, that never acknowledges its own gaps, that presents complex historical processes as simple and inevitable, that kind of story deserves a second look. And when you take that second look at how these systems were actually built, who built them, and what the full effect on working families has been across generations, the official explanation begins to feel like only part of the picture. What the rest of the picture contains is, for now, still unclear. Every system that feels permanent was once new. Every arrangement that seems natural was once a choice. And sometimes, when you trace a system back to the moment it was actually introduced, you find that the original reasons for its existence look quite different from the reasons given for keeping it in place today. The withholding system, the mechanism by which taxes are removed from wages before a worker ever receives them, is one of those systems. It feels permanent because it has been in place for most living people's entire working lives. But it was not always this way, and understanding how it began raises questions that its current form tends to discourage people from asking. To understand what changed, it helps to understand what existed before. In the earlier decades of the 20th century, income taxation in many countries operated differently than it does today. Workers received their full wages. The complete amount, reflecting the actual agreement between employer and employee, was paid over. Tax obligations existed, but they were handled separately, at specific intervals, end of year, quarterly. Depending on the jurisdiction, workers calculated what they owed and made direct payments to the relevant government authority. This older system had a quality that the current one does not. It was visible. Every worker who paid taxes under that arrangement knew two numbers with equal clarity. They knew what they earned, and they knew what they paid. The gap between those two numbers was something they experienced directly, as a real transaction, not an abstraction, not a line on a document. An actual moment where money that had been in their possession was handed over or transferred out. That experience created a clear and present awareness of the cost of taxation in personal, immediate terms. This is not a small distinction. There's a meaningful difference between losing something you have held and never receiving something in the first place. Psychologically, these two experiences do not register the same way. When you have money and then give it, you feel the giving. When money is removed before it arrives, the feeling is different. The amount that reaches you begins to feel like the real number. The amount that was removed begins to feel like it was never really yours to begin with. This is not speculation. It is a well-documented aspect of how human beings process financial transactions and perceived ownership. But this is where it becomes unclear, because at some point, the direct payment system was replaced. Not through a broad public debate about which approach better served workers, not through a careful, transparent evaluation of the psychological and practical trade-offs between the two methods. It happened through specific legislative decisions, made during specific periods of pressure, framed as practical solutions to immediate problems. And the framing, in most cases, was temporary. The shift toward automatic payroll, withholding in various countries, happened most significantly during and around periods of major national crisis. Wartime, in particular, created conditions where governments needed to collect revenue faster, more reliably, and in larger volumes than the existing systems could easily manage. The argument made at the time was straightforward. Automatic withholding was more efficient, more consistent, and better suited to the demands of the moment. It was introduced as a wartime measure, a practical response to extraordinary circumstances, not a permanent restructuring of the relationship between workers and their earnings. That framing matters. When something is introduced as temporary, there is an implied promise. The situation will pass. The measure will end. The original arrangement will resume. People accept temporary disruptions differently than they accept permanent changes. And in several significant cases, the people and institutions affected by withholding were assured, or at least led to believe, that the arrangement would not outlast the crisis that justified it. But it never went away. The crisis passed. The wars ended. The emergency conditions that had provided the justification for automatic withholding resolved. And yet the mechanism remained. In most of the countries that introduced it during these periods, withholding became a permanent feature of the wage system. It was not removed. It was not debated as a peacetime question. It simply stayed, and over time, the generation that remembered the older system aged out, and the new generation grew up knowing only the withholding model as normal. This raises questions that deserve more attention than they typically receive. If the system was genuinely temporary, What was the process by which it became permanent? Was there a decision made to keep it? If so, who made that decision and on what grounds? Or did it simply persist through institutional inertia? Nobody actively chose to continue it, but nobody actively chose to end it either, and so it remained? Both of these possibilities raise their own concerns. An active decision to make permanent a system that was promised as temporary is worth examining. But institutional inertia, a system continuing simply because dismantling it required effort that nobody undertook, is its own kind of explanation, and not a fully satisfying one. Some researchers who have examined this history point to something specific about what the withholding system accomplishes beyond its stated administrative purpose. When money is removed before it reaches the worker's psychological relationship to that money changes in a documented and significant way. The take-home amount becomes the reference point. The withheld amount becomes, in the minds of most people, something closer to a hypothetical. You know exists on paper. You see it listed on your pay stub, but you never held it, never managed it, never made a decision about it. It passed through your employment record without ever truly passing through your hands. The effect of this, some argue, is that workers become less aware of the actual scale of their tax contributions, not because they are unintelligent or uninformed, but because the system is structured in a way that removes the most visceral form of awareness, the direct experience of payment, and a population that is less aware of what it contributes is, in a practical sense, less likely to examine or challenge that contribution. Whether this outcome was anticipated by those who designed the withholding system, or whether it emerged as an unintended consequence, is something the historical record does not answer clearly. Others disagree with this interpretation entirely. They argue that the withholding system is exactly what it presents itself as, an administrative efficiency with no deeper significance. Collecting taxes gradually across a year is simply more practical than demanding large annual payments. The psychological dimension, in this view, is either overstated or irrelevant. The system serves the people it was designed to serve by making compliance easier and reducing the burden of large single payments. There is nothing hidden in its design. It is simply a practical tool. At first, this counterargument seems reasonable. There is genuine logic in spreading payments across time. The administrative efficiency argument is not invented, but there is a problem with accepting it as the complete explanation. Because if the primary purpose of withholding is convenience for the taxpayer, reducing the burden of large annual payments, then the system could have been designed in other ways that achieved the same goal while preserving the workers' direct awareness of what was being paid. Workers could have been given accounts into which their tax contributions were held, visible and accessible as a separate number throughout the year. The deduction could have been made transparent in ways that made the full amount feel as real as the take-home amount. These alternatives were not widely explored or implemented. The design that was chosen is specifically the one that removes the money before it arrives and makes the withheld amount feel abstract. That design choice does not prove intent, but it is worth noticing, because when a system has a particular effect, in this case, reducing psychological awareness of the scale of wage deductions, and that system was chosen over alternatives that would not have produced that effect, the question of why that specific design was selected becomes relevant. And this is where the explanation becomes difficult, because the historical record of who advocated most strongly for automatic withholding in various countries is not primarily a record of worker advocates and labor representatives pushing for a system that would benefit working people. The strongest institutional support for withholding systems tended to come from government revenue departments seeking more reliable collection, and from financial and administrative advisors whose interests were closely tied to government efficiency. This does not mean the system was designed against workers, but it does suggest that the convenience it was designed to provide was not primarily the workers' convenience. The original direct payment system, for all its inefficiencies, gave workers something that the withholding system does not. It gave them a clear, felt, immediate experience of the full scope of their financial obligations. It made the numbers real in a way that a line on a pay stub cannot fully replicate. When that system was replaced, temporarily, then permanently, something about the relationship between workers and the true cost of their employment arrangements changed. Whether that change was a side effect or a feature of the redesign is a question that neither side of the debate has fully settled. Both explanations exist and continue to be held by serious people. The administrative efficiency view is coherent. The psychological significance view is supported by what we know about human behavior and financial perception. Neither fully settles the question of why a temporary measure became permanent, or why the specific design chosen was the one that minimized direct awareness rather than preserving it. And that unresolved space between two explanations that both contain truth, but neither of which completely accounts for the full picture, is exactly where the first real doubt about the official story begins to take shape. The withholding system is presented as a simple administrative tool. Perhaps it is, but it is also something that changed how workers understand their own earnings. And that change, however it happened, has never been reversed. Why not is a question that remains, for now, without a clear answer. To understand how the relationship between workers and their wages changed so dramatically over the past century, it helps to step back, not just to look at the systems themselves, but to look at the world they grew out of. The conditions that existed before income taxation on ordinary workers became standard, the economic landscape that made the shift possible, and the specific moments when that landscape changed in ways that affected almost everyone who worked for a living, whether they noticed it or not. For most of recorded history, governments collected revenue through mechanisms that had little direct contact with the ordinary worker's wage. Tariffs were among the most common. A tariff is a tax placed on goods entering a country from outside. When a merchant imported cloth, grain, tools, or any traded commodity, a portion of its value was paid to the government as a condition of entry. This system had a certain logic to it. Trade was visible, trackable, and concentrated in specific ports and commercial centers. Collecting from merchants and importers was administratively simpler than reaching into the wages of millions of individual workers scattered across an entire economy. Beyond tariffs, governments also drew revenue from taxes on large estates, inherited wealth, and business profits. These were targeted at the upper levels of society, at the people and institutions that held significant accumulated wealth. Again, the logic was practical. Wealth was concentrated enough in these areas to generate meaningful government revenue without requiring a complex system for reaching ordinary working people. The average laborer earning wages in a factory, on a farm, or in a trade was largely outside the direct taxation relationship with the state, not invisible, but not a primary target of revenue collection. This arrangement was not perfect. Tariffs raised prices on imported goods, which affected ordinary consumers. Taxes on business profits could influence wages and employment. The system was not as cleanly separated from working life as it might appear on the surface. But in direct terms, in terms of money removed from wages, working families in the 19th and early 20th centuries contributed far less directly to government income than their descendants would come to experience. That gap between then and now is significant, and the process by which it closed is worth examining carefully. The opening of the 20th century brought changes that would reshape this arrangement fundamentally. In the United States, the introduction of a federal income tax in 1913 was a constitutional event. It required an amendment to the founding document of the country, which indicates both the significance of the change and the degree of resistance it had previously encountered. The amendment passed, and with it came a new category of government revenue, a direct tax on what individuals earned. But the early version of this tax was narrow in its reach. It applied to incomes above a threshold that, in practical terms, meant only the wealthy were affected. A small fraction of the population fell within its scope. For most working Americans, the federal income tax was, at its introduction, an abstract thing, something that applied to other people. Similar patterns appeared in other countries. During the same period, governments across Europe and elsewhere were developing their own income tax frameworks, generally with similar initial designs. High thresholds, narrow application, a focus on the economically privileged rather than the broad working population. The political framing in many cases was explicitly one of fairness, making those with the most contribute more to the shared systems that protected everyone. This was not an unreasonable argument, and it was persuasive enough to establish the principle that income could be taxed directly by the state. But this is where it becomes unclear, because once that principle was established, once the legal and administrative framework for taxing income existed, something began to happen that the original framing did not fully anticipate, or at least did not openly discuss. The thresholds moved. Not suddenly, not through any single dramatic legislative act that drew widespread public attention and debate. Gradually, and in ways that were individually justifiable, the income levels at which taxation began were adjusted. More people fell within the taxable range. The tax that had been introduced as a measure targeting the wealthy began, over decades, to reach further down the income scale. At first, it seems like a reasonable evolution of policy. Governments took on larger roles as the century progressed. Public education expanded. Infrastructure grew. Healthcare systems developed in various forms. Military expenditures fluctuated but trended upward. All of this required funding, and broadening the tax base was one logical response to growing revenue needs. The expansion of income taxation to middle incomes, and eventually to almost all wage earners, can be told as a story of governments growing to meet growing demands. And that story is not entirely wrong, but there is a problem with accepting it as the complete explanation. The timing of the most significant expansions does not consistently align with calm periods of open democratic debate. Some of the largest and most consequential shifts in who paid income tax and how much happened during periods of national emergency. Wartime, particularly, created conditions where expanding taxation was framed as patriotic necessity. Questioning whether a tax expansion was appropriate, or whether its design served the public interest fairly, carried social costs during wartime that it would not have carried during peacetime. The person who raised concerns about tax policy while soldiers were in the field risked being seen as obstructionist or worse. This timing is worth noting carefully. It does not mean the expansions were wrong in every case, or that wartime governments acted in bad faith when they broadened the tax base. The revenue needs during major conflicts were real and urgent, but it does mean that some of the most significant changes to who bore the burden of income taxation happened at moments when the normal conditions for public deliberation, open debate, free criticism, organized opposition were compressed or suppressed. Important decisions were made in constrained environments, and those decisions, once made, tended to persist long after the constraints were lifted. There is another dimension to this background that the standard history tends to move past quickly. The people who designed the early income tax systems, who wrote the legislation, set the thresholds, defined the categories, and built the administrative frameworks, were not a random cross-section of society. They were predominantly drawn from legal, financial, and governmental circles. They were educated in institutions that shaped particular views about economic organization. They had professional and social connections to the institutions and individuals who would be most directly affected by the design choices they were making. This does not automatically mean the systems they built were designed against ordinary workers, but it raises a question about whose perspective most naturally shaped the architecture of these systems, and whose perspective was most likely to be underrepresented in those rooms. The expansion of income taxation to ordinary workers did not happen in a single moment that history can point to and examine. It happened across decades, in multiple countries, through accumulated adjustments that each seemed modest on their own. This gradual quality made it difficult to identify a turning point, to name a specific decision that could be debated or reversed. By the time the full scope of the change was visible, by the time income taxation of ordinary wages was simply the way things worked, it had already been normalized across an entire generation's experience. And this is where the explanation becomes difficult, because normalizing something is not the same as justifying it. A system can become accepted and familiar without ever having been openly chosen. The ordinary worker of the mid-20th century, who accepted income tax deductions as simply part of life, was not making an active choice to endorse the system. They were adapting to an environment that had been shaped by decisions made before them, in circumstances they had not participated in, by people whose interests were not identical to their own. Some historians argue this is simply how policy works. Change accumulates. Each generation inherits the arrangements of the previous one. There's no moment of pure original choice. Systems evolve, and the people within them adapt. This is a reasonable observation, and it applies to many areas of social organization beyond taxation. Others point to something more specific. They note that the direction of expansion, from taxing the wealthy toward taxing everyone, moved consistently in one direction over this period. The thresholds did not expand and then contract. They did not move toward the wealthy in some periods and toward ordinary workers in others. The direction was consistent. And consistent directional change, especially when it occurs across different countries, with different political systems and different governments, deserves more explanation than the simple story of growing government needs provides. The background to all of this is not a simple picture of governments doing what was necessary and citizens accepting what was fair. It is a more complicated landscape of decisions made under specific pressures by specific people at specific moments when normal scrutiny was limited. The income tax that was introduced as a narrow measure affecting only the very wealthy became, within decades, a system touching almost every person who received a wage. That transformation happened. It is documented. What is less clear is whether it happened the way it did because it had to, because the logic of governing modern societies inevitably led there, or because it happened to serve interests that benefited from broadening the collection of wages. The numbers changed. The thresholds moved. More people paid. And the conditions under which those changes happened raise questions that a simple story of necessary expansion does not fully resolve. What drove the direction of that expansion? Genuine public need, institutional design, or something else entirely, remains, on careful examination, less settled than the official history of income taxation tends to suggest. Numbers tell stories. Not always the stories we expect, and not always the stories we are told. But when you look at economic data carefully, when you trace the relationship between what workers produce and what workers receive across decades, a particular story begins to emerge. It is not a story that appears in most introductory explanations of how wages work. It is not the story that official sources tend to lead with. But it is there, documented and measurable, and it raises questions that the standard explanations have not fully answered. To understand the inconsistency, it helps to start with the basic principle. In a functioning market economy, wages are supposed to reflect the value that workers create. This is not a radical idea. It is the foundational logic of how employment is described in standard economic theory. A worker produces something of value. An employer compensates the worker for that production. The compensation should, over time, reflect the actual value being generated. When workers become more productive, when they produce more value per hour through better tools, better processes, better organization, their wages should, by this logic, rise to reflect that increased contribution. For a period in the mid-20th century, this relationship appeared to hold. In many developed economies, particularly in the decades following the Second World War, wages and productivity moved in a broadly similar direction. Workers produced more as technology and industrial organization improved. Their wages reflected at least a portion of that improvement. Living standards rose for significant portions of the working population. Homeownership expanded. Families could plan futures with some confidence that sustained effort would translate into sustained improvement. The basic promise of the wage relationship, work harder, produce more, receive more, appeared, during this window, to be functioning. But something changed, and the change is not subtle. When economists and researchers began examining wage and productivity data from the 1970s onward, a gap appeared that had not been clearly visible before. Productivity continued its upward trajectory. Technology kept improving. Workers kept producing more value per hour. The efficiency of labor, measured by the economic output it generated, kept rising across the following decades and into the present. This is not disputed. The productivity numbers are documented and widely accepted. What did not continue rising at the same rate was wages. Beginning in the 1970s in the United States and in various forms across other developed economies, the link between productivity growth and wage growth weakened significantly. Workers were producing more, but what they received for that production stopped growing in the same proportion. The two lines, productivity and wages, which had moved together during the post-war period, began to diverge, and over the following decades, that divergence became increasingly wide. This is where it becomes unclear, because the gap itself is not disputed. Economic researchers across different institutions and different political orientations have documented it. The disagreement is not about whether the gap exists. The disagreement is about what caused it and what it means. And the explanations offered by official and mainstream sources, while not without logic, leave a number of questions unresolved. The most commonly offered explanation points to globalization. Beginning in the latter decades of the 20th century, trade barriers reduced, supply chains extended across international borders, and workers in developed economies found themselves competing with labor markets in countries where wages were significantly lower. Employers, the argument goes, had less pressure to raise wages when they could access cheaper labor elsewhere. The market for labor became international, and the price of labor in wealthy countries adjusted downward in relative terms as a result. Automation is offered as a related explanation. As technology advanced, machines and software began performing tasks that had previously required human labor. This reduced demand for certain categories of workers, which reduced their bargaining power, which reduced wage growth. Both globalization and automation are real phenomena. They genuinely affected labor markets. The explanation is not invented, but at first it seems complete, and then a problem appears. Because globalization and automation do not fully account for the specific pattern that emerged. If market forces simply repriced labor downward due to international competition and technological substitution, you would expect wages to fall in the areas most exposed to those pressures and to continue growing in areas less exposed. You would also expect the productivity gains from automation to eventually translate into wage gains somewhere as the economy expanded and new categories of work emerged. In some cases this happened. In many cases it did not. And the overall direction, productivity rising, wages lagging, remain consistent across many sectors and many categories of workers in ways that the market force explanation does not cleanly predict. And this is where the explanation starts to weaken further. Because during the same decades when wages were failing to keep pace with productivity, something else was happening simultaneously. The total financial burden carried by working families was not shrinking. It was growing. Taxes, though they fluctuated by country and political period, remained a significant portion of income. Insurance costs, health property vehicle expanded. Housing costs, particularly in urban areas where employment was concentrated, rose well above general inflation rates. Debt obligations grew as families borrowed to cover gaps between wages and costs. So the picture that emerges from the data is not simply one of wages failing to rise. It is a picture of workers producing more, receiving proportionally less of what they produced, and simultaneously owing more from what they did receive. Each element of this pattern has its own official explanation. The wage gap is attributed to market forces. The rising costs are attributed to supply and demand in various sectors. The growing debt is described as a personal financial choice. But when you step back and look at the three elements together, more productivity, less proportional wage, more obligation, the combined picture is harder to explain through the standard single-issue frameworks. Some economists have pointed to a related observation that adds another layer to this. During the same period when wages diverged from productivity, the share of economic output going to corporate profits and to returns on capital investment grew significantly. This means that the value being created by the economy as a whole did not disappear. It continued to grow. It was simply distributed differently than it had been in the earlier post-war decades. A larger share went to owners of capital. A smaller share went to providers of labor. This shift is documented in the same economic records that show the productivity wage gap. This raises a question that the official explanation does not fully address. If productivity kept rising, and the overall economy kept growing, and the value created by workers kept increasing, where did the value go that did not reach wages? The market forces explanation says it went to shareholders and capital owners because that is what competitive markets produced. Some accept this answer. Others find it insufficient because it explains the mechanism without explaining why the mechanism shifted so significantly during this particular period and why it shifted so consistently in the same direction across different countries. There is also a dimension of this that connects back to what was discussed earlier, the structure of deductions and obligations. Even in cases where nominal wages did rise during this period, The increase in obligations meant that real take-home purchasing power did not always follow. A worker receiving a wage increase that was partially offset by rising insurance premiums, rising housing costs, and growing debt repayments did not experience that increase as meaningful improvement. The number on the pay stub might have grown. What that number could actually purchase, after all obligations were met, was a different question. And for many families, the honest answer to that question was that purchasing power was stagnant or declining even when the nominal wage number was technically moving upward. This distinction between nominal wages and real purchasing power after obligations rarely appears prominently in official discussions of wage trends. Standard wage data typically measures nominal figures, the lived experience of what those wages actually provide, after the full structure of obligations is accounted for, is harder to capture in simple statistics. And this is where the explanation becomes difficult, because the official version of events, productivity grew, wages followed with some lag due to market forces, and the overall system functioned as expected, simply does not match what many working families experienced during the same period that the official data describes. What the data actually shows, when examined without the framing that market explanations provide, is something more specific and more puzzling. A period in which workers became significantly more productive. A period in which that productivity did not translate proportionally into what workers received. A period in which the obligations attached to wages grew at the same time that wages lagged. And a period in which the value that did not go to wages went visibly and measurably elsewhere. All of this is documented. All of it is real. What it means, whether it reflects a natural and acceptable outcome of market evolution, or whether it reflects a structural shift in how economic value is distributed that deserves more examination, is where the disagreement lies. And that disagreement has not been resolved. It continues among economists, policy researchers, and historians who look at the same data and reach different conclusions about what it reveals. The math is there. The records are there. Workers produced more. Workers received proportionally less. Workers owed more from what they received. The numbers move consistently in these directions across several decades. Why the numbers move this way, and whether the explanations offered fully account for the pattern, remains, on careful and honest examination, an open question, one that the data raises clearly, and that the official explanation has not yet fully answered. There is a point in any investigation where the surface explanation runs out, where the official account covers the visible facts, but leaves something underneath unaddressed. The previous chapter traced how productivity and wages diverged, how workers produced more and received proportionally less over several decades. That gap is real and documented, but it immediately creates a practical question that the productivity wage story alone does not answer. If wages were not keeping pace with the cost of living, how did working families continue to function? How did they pay for homes, education, healthcare, and the ordinary expenses of modern life when their wages were not growing fast enough to cover those rising costs? The answer, in most cases, was debt. And the story of how debt expanded during precisely the same period that wages stagnated is one of the more striking patterns in the modern economic record. It is also one that the standard explanation handles less comfortably than it handles the wage question, because the timing, the scale, and the specific design of how consumer debt expanded raises questions that a simple story of supply meeting demand does not fully resolve. To understand the scale of the shift, it helps to look at where consumer debt stood before the critical transition period. For most of the early and mid-20th century, personal borrowing existed but occupied a more limited role in family finances. Mortgages allowed homeownership. Some installment credit existed for large purchases. But the idea of carrying ongoing revolving debt, borrowing regularly, paying minimums, carrying balances across months and years, was not a normal feature of working family life in the way it later became. Debt was used for specific, bounded purposes. It was not a general substitute for income. That began to change in the 1970s and accelerated through the 1980s and beyond. Credit cards, which had existed in limited forms earlier, expanded dramatically during this period. The terms under which they were offered became more accessible. The credit limits extended to ordinary working families grew. The financial infrastructure for processing and managing large volumes of revolving consumer debt developed rapidly. At the same time, mortgage products became significantly more varied and complex. Loans with structures that would have been unusual or unavailable in earlier decades became standard offerings. Student lending grew from a modest support system into a massive financial instrument affecting millions of families. And personal loan products of various kinds multiplied across the market. The timing of this expansion is what makes it interesting. It did not precede the wage stagnation period. It did not happen during a time of broadly rising wages, when families might have borrowed in confidence that growing income would easily service growing debt. It happened during the same decades, when real wage growth slowed. As the gap between what wages covered and what modern life cost began to widen, credit was there to fill it, almost as if the space created by one shift was occupied immediately by another. This is where it becomes unclear, because a coincidence of timing at this scale and consistency is worth examining carefully. The standard explanation describes this as a natural market response. There was genuine demand for credit among families whose wages were not covering their expenses. Financial institutions recognized that demand and developed products to meet it. Interest rates were deregulated in ways that made lending more profitable and therefore more attractive to financial providers. The market, in this account, simply did what markets do. It identified a need and supplied a product to meet it. This explanation has internal logic, and it is not entirely wrong. But there's a problem with stopping there, because the market response explanation treats the demand for credit as an independent starting point, as though families simply decided they wanted to borrow more, and financial institutions responded to that preference. It does not fully account for why the demand existed in the first place. If wages had kept pace with productivity and costs, the demand for credit as a substitute for income would have been significantly smaller. The need that credit filled was itself created by the wage stagnation that preceded and accompanied the credit expansion. So the market was not simply responding to a preference. It was responding to a gap that had its own causes and its own history. And this is where the explanation becomes difficult, because debt is not a neutral tool. It is not simply a bridge that families cross and then leave behind. Debt carries interest. Every month that a balance is carried, a portion of the borrower's income flows to the institution that extended the credit. This flow is not incidental to the arrangement. It is the point of it, from the lender's perspective. The interest is the return on the lending institution's investment. And over time, across millions of borrowing families, that flow of interest represents an enormous and continuous transfer of income from workers to financial institutions. The financial sector's growth during this same period is documented clearly. Banks, lending companies, credit card issuers, and associated financial institutions expanded significantly in size, profitability, and economic influence during the decades when consumer debt was rising. This parallel expansion is sometimes described as coincidence. The financial sector grew because the broader economy grew, and both trends happened to occur during the same period. Some believe this. Others find it insufficient as an explanation, because the financial sector's growth specifically tracked the expansion of consumer debt in ways that suggest direct connection rather than parallel coincidence. When you trace the full cycle that working families moved through during this period, the pattern takes on a particular shape. A family earns wages. From those wages, a portion is removed through taxes and deductions before arrival. From the remainder, ongoing obligations, insurance, housing, utilities, consume a significant share. What remains covers basic living expenses, often with little surplus. When costs exceed what wages and remaining income can cover, for education, for medical needs, for housing and markets where prices rose faster than wages, the family borrows. The borrowing generates interest payments, which add a new and ongoing obligation to the existing ones. The cycle then repeats, with the interest payments joining the list of fixed obligations that wages must cover. Each step in this cycle has a conventional explanation. Deductions fund public services. Insurance payments provide protection. Debt enables access to things that wages alone cannot immediately purchase. Interest compensates lenders for the risk of lending. Every individual step sounds reasonable, but the cumulative structure, the overall shape of the cycle, means that a working family's income flows outward in multiple directions simultaneously and continuously. What remains after all the outflows is what the family actually lives on. And for many families, that remainder has been under consistent pressure for decades. This raises a question that is difficult to dismiss simply by explaining each component individually. When multiple systems, wage structures, tax frameworks, insurance markets, lending products, all happen to draw from the same source simultaneously, and when that combined drawing consistently leaves families with less over time, the question of whether these systems are truly independent becomes harder to answer comfortably. Some researchers argue that the convergence is not design but structural, that different parts of the economic system independently tend toward extracting value from labor because that is how market economies function. Others suggest that the degree of coordination, the consistency of direction, and the timing of these developments across different countries indicate something with more coherent organization behind it. Neither position can be fully proved with the available evidence, but neither can be dismissed as obviously wrong. And that uncertainty is itself significant, because if the expansion of consumer debt during the wage stagnation era was purely a natural market response to independent demand, we should be able to explain with confidence how the supply of credit appeared so smoothly and so quickly at precisely the moment it was needed. We should be able to explain why the financial institutions that provided that credit grew in step with the obligations they created. And we should be able to explain why the families who borrowed faced the specific terms, interest rates, repayment structures, penalty arrangements that were offered to them. Some of those explanations exist in partial forms. Deregulation in the financial sector during the 1970s and 1980s made certain lending practices more profitable and therefore more common. Policy decisions removed caps on interest rates that had previously limited what lenders could charge. These are documented changes with documented effects. But policy decisions do not happen in isolation. They are made by people in response to lobbying and influence, and the institutions that benefited most from financial deregulation were often the same ones most actively advocating for it. This does not prove that the overall pattern was designed, but it does complicate the picture of neutral market forces naturally finding equilibrium. What the evidence consistently shows is a pattern. Wages slowed. Costs continued rising. Debt expanded to fill the gap. Interest on that debt created new and ongoing obligations. Financial institutions grew as those obligations multiplied, and working families found themselves in a cycle where the relationship between their labor and their actual financial security became steadily more complicated and more mediated by systems they did not control and had not fully chosen. Whether that pattern represents a series of independent coincidences that happen to move in the same direction, or whether it reflects something with more organized structure behind it, is not a question the current evidence fully resolves, but it is a question that the pattern itself keeps raising, clearly, consistently, and without a satisfying answer in sight. There is a principle that investigators apply when examining complex situations. A single unusual event can be coincidence. Two similar events in different places might still be explained by independent causes. But when the same pattern appears repeatedly, across different environments, different systems, and different time periods, all moving in the same direction, that is when coincidence becomes a less satisfying explanation. That is when the pattern itself becomes the thing that requires answering. The shifts described in previous chapters, wage stagnation relative to productivity, expanding consumer debt, multiplying financial obligations, might be easier to dismiss if they appeared in only one country. A single nation's policy failures, a particular government's decisions, a specific cultural or economic circumstance that produced unusual outcomes in one place. But that is not what the record shows. The record shows something considerably more difficult to explain through single-country analysis. Across multiple developed economies, countries with genuinely different governments, different political traditions, different cultures, and different stated economic philosophies, broadly similar shifts occurred during broadly similar time frames. The United Kingdom, the United States, Canada, Australia, and various European nations each had their own political landscape, their own legislative processes, their own debates, and yet the direction of change in how working families related to their wages, their debt, and their financial obligations moved with notable consistency across these distinct environments. Wage growth relative to productivity slowed. Consumer debt expanded. The total burden of financial obligations on ordinary families grew. The gap between earning and keeping widened. This consistency across borders is what economists refer to as convergence, and the standard explanation for it points to globalization. The argument is straightforward. As economies became more integrated through trade, shared financial systems, and international capital movement, the pressures acting on labor markets became increasingly similar regardless of national context. A company operating in multiple countries faces similar market pressures everywhere. International financial institutions and agreements create common frameworks that different governments operate within. The result, in this view, is that economies naturally move in similar directions because they are exposed to similar forces, not because anyone coordinated the outcome. This explanation has genuine content. Globalization is real. International economic integration did create shared pressures across national labor markets. The argument is not invented, but this is where it becomes unclear, because the globalization explanation, while it accounts for why pressures might be similar, does not fully account for why the responses to those pressures were so consistently identical in their effects on working families. Different governments with different political ideologies, some more protective of labor, some more oriented toward market flexibility, all presided over broadly similar outcomes for workers. That similarity across genuinely different policy environments is harder to explain through shared external pressure alone. And this raises a question that the convergence explanation tends to move past. If different countries with different governments made different decisions, but arrived at similar outcomes for working families, what does that suggest about where the decisions that actually mattered were being made? National governments set policy, but international institutions, the International Monetary Fund, the World Bank, trade agreement frameworks, and various transnational financial bodies also shaped the conditions within which national governments operated. The policy space available to any individual government was not unlimited. It was bounded by international frameworks, debt obligations, credit ratings, and financial market pressures that operated above the national level. This does not mean national governments had no agency. They made real choices with real effects. But it raises an honest question about the level at which the most consequential decisions about the structure of wages and financial obligations were actually being determined. And the answer to that question is not as clearly democratic or as clearly national as the official account of these changes typically presents. There is a second dimension to this pattern that deserves equally careful attention. It is not just that the same outcomes appeared across different countries. It is also that the process by which those outcomes were reached followed a remarkably similar structure in each place. Each new financial obligation, each new deduction, each new insurance requirement, each new fee attached to a basic service was introduced individually, separately, with its own specific justification, its own framing, its own presentation as a limited and necessary measure. At first, this seems like normal policy process. Different obligations arise from different circumstances and are introduced at different times. Of course, they each have their own explanation. That is simply how legislation and regulation work. Each change addresses a specific identified need. Each comes with its own rationale. This is how complex societies manage complex systems. But there is a problem with accepting this as a complete explanation, because when you examine the cumulative effect of these individually justified changes, when you add together the deductions, the premiums, the fees, the obligations that each arrived with its own reasonable story, the combined picture looks very different from what any individual justification would suggest. Each piece seemed modest. Each piece was described as necessary and proportionate. Each piece was presented as bounded, as solving a specific problem without broadly restructuring the relationship between workers and their earnings. The accumulated reality tells a different story. A worker looking at their full financial picture, their gross wage, their deductions, their insurance obligations, their debt repayments, their housing costs relative to income, faces something that no individual policy announcement ever described or invited them to evaluate as a whole. The pieces were introduced separately. They were never presented together. And this separation meant that the full scope of the transformation in working family finances was never clearly visible at the moment it was happening. This is exactly the kind of pattern that careful investigators notice, not because any individual piece is necessarily suspicious on its own, but because consistent directional movement across many pieces over many years in many countries, all drawing from the same source, labor income, without any individual moment where the total effect was honestly presented for evaluation, represents something that deserves more scrutiny than simple policy accumulation usually receives. Some researchers who have examined this pattern describe it as structural drift. The idea is that complex economic systems contain inherent tendencies, and that without active counterpressure, those tendencies naturally move in particular directions. Financial systems, in this view, drift toward extracting more from labor because that is where consistent, reliable value flows. Each individual extraction mechanism is created and justified on its own terms, but the overall drift is the result of the system's inherent tendencies rather than anyone's explicit plan. This explanation is thoughtful and has support among serious economists. Others disagree. They argue that the consistency of the pattern, the similar timing, the similar design, the similar outcomes across different national contexts, is too regular to be explained by independent drift. They point to the role of specific international institutions, specific policy frameworks that were promoted and disseminated across multiple countries during the same periods, and specific networks of advisors, economists, and financial professionals who moved between institutions and governments and carried consistent ideas about how labor markets and financial systems should be structured. In this view, the convergence was not accidental. It reflected the active promotion of particular frameworks by people and institutions with consistent interests. Both positions remain contested. Neither has been definitively proved or disproved. And this uncertainty is itself part of the pattern, because the absence of a clear, documented, central coordination point makes it genuinely difficult to assess whether the consistency of outcomes reflects design or drift. That ambiguity may be incidental, or it may be a feature of how these changes were structured. What is not ambiguous is the experience that working families across these different countries share. The difficulty of explaining why wages feel insufficient. The normalcy of carrying debt that previous generations would not have considered standard. The sense that financial obligations multiply faster than the ability to meet them. The feeling that something about the relationship between work and security has shifted without a clear moment to point to, without an obvious cause, without a single decision that changed everything. This shared experience across different countries and different generations is itself a kind of evidence. Not evidence of any specific design or intention, but evidence that the pattern is real, that it is broad, and that the explanations offered for it individually do not fully account for it collectively. When families in different countries, under different governments, in different economic systems, describe the same relationship between their work and their financial reality, when the pattern of earning more and keeping less, of obligations multiplying faster than income, of debt filling the gaps that wages no longer cover appears consistently across these different environments, the question of why this particular pattern is so universal becomes difficult to set aside. The individual explanations for each component of the pattern exist. They are available. They are offered regularly by official sources and mainstream economists. Each piece, examined alone, has a reasonable account attached to it, but the pieces consistently move in the same direction, across borders, across decades, across genuinely different political and cultural environments. And the explanation for why they all move the same way, for why the convergence is so consistent and so directional, remains, on honest examination, less clear and less settled than the confidence with which individual pieces are explained would suggest. That gap between the confidence of the individual explanations and the inadequacy of the collective one is where the pattern becomes most visible and most in need of a more complete answer. At first, this seems like a sector-specific problem. Education costs rose because institutions expanded, because research became more expensive, because administrative structures grew. These explanations exist and contain partial truth. But there's a problem with treating education costs as an isolated development. Because the same families who are navigating higher housing costs are also navigating higher education costs. And they are doing so with wages that, as established in earlier chapters, have not grown proportionally to meet these rising demands. The pressures are not occurring in separate compartments. They are accumulating in the same household budget, against the same income, at the same time. Healthcare follows a similar trajectory. The specifics vary significantly by country. Some nations have public health systems that cover a larger share of costs. Others rely more heavily on private insurance markets. But across most developed economies, the out-of-pocket financial burden of healthcare on working families has grown over recent decades. Insurance premiums, where insurance is required, have increased. Co-payments and deductibles have risen in systems where they exist. Services and medications that were previously covered have moved into cost-sharing arrangements. And in countries without comprehensive public systems, the exposure of ordinary families to potentially catastrophic medical costs has remained a persistent source of financial vulnerability. What makes this significant in the context of everything else is not any individual feature of healthcare costs. It is the addition. Healthcare costs are added to housing costs. Housing costs are added to education costs. Education costs are added to the wage deductions and financial obligations discussed in earlier chapters. Each item, examined alone, has its own explanation. Each has its own policy history, its own market dynamics, its own set of causes that economists and analysts can point to. But working families do not experience these costs separately. They experience them simultaneously, from the same income, in the same monthly budget. And this is where the explanation becomes difficult, because when you step back and look at the three areas together, housing, education, healthcare, something consistent appears. Each of these represents a fundamental human need. Each was, within living memory, considered accessible to working families without requiring extraordinary sacrifice or substantial debt. And each has shifted, during broadly the same historical period, into territory where debt is now standard and where significant financial strain is the normal experience rather than the exceptional one. The standard explanations for each area point to different causes. Housing costs are attributed to land constraints, investment patterns, and regulatory environments. Education costs are attributed to institutional expansion and the shift toward market pricing. Healthcare costs are attributed to technological advancement, aging populations, and insurance market structures. These are not the same explanation. They do not share an obvious common mechanism, and yet the direction of change is identical across all three. Each shifted in the same period. Each moved in the same direction relative to wages. Each transformed from a domain of relative accessibility into a domain of significant financial pressure requiring debt or sacrifice. The consistency of direction across areas with different explanations is something that the individual explanations do not account for. Each explanation tells you why costs rose in its specific domain. None of them explains why all three domains moved in the same direction at the same time. Some researchers argue this is simply what happens when economies mature and societies become more complex. Advanced services become more expensive as they incorporate more technology, more specialization, more infrastructure. Housing in productive urban areas commands higher prices because land in those areas is scarce and valuable. Education reflects the increasing complexity of the knowledge economy. Healthcare reflects genuine advances in what medicine can accomplish. These are not unreasonable observations. Others point to something more specific. They note that in each of these domains, housing, education, healthcare, the shift toward higher costs for families was accompanied by the development or expansion of financial instruments designed to fund those costs through debt. Housing prices rose alongside the development of more complex mortgage products. Education costs rose alongside the expansion of student lending systems. Healthcare costs remained high in contexts where insurance products were the required mechanism for access. The financial infrastructure for converting each domain's costs into ongoing debt obligations was, in each case, present and expanding at the same time that costs were becoming unmanageable through income alone. This parallel development, costs rising, debt products expanding simultaneously, in multiple domains, during the same period, raises questions that the independent causes explanation does not easily address. It does not prove coordination. It does not establish that these developments were planned or organized toward a common goal. But it does establish that the pattern is broader and more consistent than any single sector explanation can account for. The problem, in other words, is not contained. It did not stay within the paycheck. It spread into the most fundamental areas of family life, the home, the education, the health, and in each area it produced the same result. What was once achievable became strained. What was once manageable became dependent on debt. What was once a realistic expectation became, for many families, a source of ongoing financial pressure that wages alone are not structured to resolve. That expansion is too broad and too consistent to be fully explained by the individual histories of each affected domain. And the question of what does explain it, what connects these separate areas and accounts for their consistent direction of change, remains genuinely and uncomfortably open. When a pattern is large enough, clear enough, and consistent enough to demand explanation, different people looking at the same evidence do not always arrive at the same answer. This is not necessarily a sign that the evidence is weak. Sometimes it reflects the genuine complexity of what is being examined. Sometimes it reflects the different frameworks and assumptions that researchers bring to their analysis. And sometimes it reflects the fact that the truth itself is layered, that multiple forces operated simultaneously, each real, each contributing, none of them alone sufficient to explain the whole picture. The pattern documented across the previous chapters is exactly this kind of complex problem. Wages diverging from productivity, consumer debt expanding to fill the gap, financial obligations multiplying across housing, education, and healthcare. Similar outcomes appearing across different countries during similar time periods. Each of these elements is documented. The disagreement is not about whether these things happened. The disagreement is about why, and the range of explanations that serious researchers and analysts have offered, each with its own internal logic, each with its own supporting evidence, each with its own significant limitations, tells us something important about how difficult the underlying question actually is. The first interpretation, and perhaps the most conventional, focuses on political failure. In this view, the changes that working families experienced over recent decades were not the inevitable result of economic forces. They were the result of governments making poor decisions, or failing to make necessary ones. Democratic systems, in this analysis, were captured, gradually and consistently, by the interests of those with the most resources to spend on influencing policy. Corporations, financial institutions, and wealthy individuals invested in lobbying, in political donations, in the cultivation of relationships with legislators and regulators. Over time, policy began to reflect their preferences more than the preferences of ordinary workers. Tax structures shifted, labor protections weakened, regulatory frameworks loosened in ways that benefited capital over labor. This explanation has considerable supporting evidence. The documented history of lobbying expenditures, regulatory changes, and the composition of advisory bodies around major economic decisions shows consistent patterns of influence from economically powerful interests. It is not a speculative claim. It is observable in legislative records, in the career paths of regulators, and in the timing of policy changes relative to industry advocacy. The political failure explanation says, in essence, that democracy was present in form but compromised in practice. And the solution it implies is straightforward in concept, if difficult in execution: better democratic representation, stronger labor voices, more transparent governance. But this is where it becomes unclear, because the political failure explanation, while well supported in many of its specific observations, still leaves a question unanswered. Political systems in different countries were captured to different degrees, at different times, through different mechanisms. And yet the outcomes for working families were broadly similar across these different political environments. If political failure in each individual country explains the outcome in that country, what explains why the failures all moved in the same direction? Independent political failures, in genuinely different systems, producing consistently similar results. That convergence requires its own explanation, which the political failure framework does not fully provide. The second interpretation shifts the focus from governments to corporations. Specifically, to the growing concentration of power among large employers and the parallel weakening of worker organizing capacity. This view argues that the balance of power within labor markets changed fundamentally during the critical decades of the late 20th century. Unions, which had provided a meaningful counterweight to employer power in many industries during the post-war period, declined in membership and influence across multiple countries. The reasons for this decline were varied, some political, some economic, some structural, but the effect was consistent. Workers lost negotiating capacity. Employers gained it. In a labor market where workers have limited ability to collectively negotiate, the individual worker faces the employer largely alone. And individual workers, who need their jobs more immediately than employers need any specific worker, are structurally disadvantaged in that negotiation. Wages can be held below productivity growth without organized resistance capable of compelling a different outcome. Benefits can be reduced. Working conditions can shift. And the gains from rising productivity, which workers in a stronger organizing environment might have successfully claimed as wage increases, instead flow toward profits and returns to shareholders. This explanation is also supported by substantial evidence. The correlation between declining union membership and declining wage growth relative to productivity is documented across multiple countries. The decades when labor organizing was strongest were broadly the decades when wage growth was most aligned with productivity growth. The decades when organizing weakened were the decades when the gap widened. Correlation is not causation, and this relationship has been debated carefully by economists. But the pattern is consistent enough that the corporate power explanation commands serious attention from researchers across the political spectrum. At first, this seems like a complete enough account, but there is a problem. Corporate power over labor markets explains wage stagnation reasonably well. It explains why the productivity gains went elsewhere. It does not fully explain the simultaneous expansion of financial obligations, the housing, education, and healthcare cost increases that compounded the wage problem. Corporations suppressing wages does not, on its own, explain why the costs of fundamental needs rose in ways that required families to take on debt. A different force seems to be operating in that dimension. This is where the third interpretation becomes relevant. Some analysts focus not on political systems or labor markets, but on the financial system itself, on the mechanics of how money is created, how debt functions, and how interest operates across an entire economy over time. This perspective argues that financial systems contain structural tendencies that consistently transfer value from those who work and borrow to those who lend and own, not through any obvious or dramatic mechanism, not through theft or fraud, but through the quiet, consistent, and compounding mathematics of debt and interest operating at scale. When families borrow to cover gaps that wages no longer fill, for housing, for education, for emergencies, they enter into arrangements where a portion of their future income is committed to servicing that debt. That commitment flows to lending institutions. At the level of an individual family, this is simply a financial arrangement. At the level of an entire economy, across millions of families carrying debt simultaneously over decades, it represents an enormous and continuous transfer of value from labor income to financial capital. The financial system explanation suggests that this transfer is not accidental. It is the predictable result of how debt-based financial systems function when a significant portion of the population is simultaneously in a position of needing to borrow. And this is where the explanation becomes difficult, because this third interpretation, while it identifies a real mechanism and is supported by observable financial data, requires accepting that the structure of the financial system itself is a primary driver of the outcomes families experience. That is a more fundamental claim than the political failure or corporate power explanations make. It implies that the problem is not simply bad policy or imbalanced markets, but something embedded in the basic architecture of how modern economies are organized. And that implication makes the question of solutions significantly more complicated. The fourth interpretation takes yet another step. It looks at the coordination of these changes, the similar timing, the similar direction, the similar outcomes across different national contexts, and suggests that the degree of convergence is too consistent to be explained by independent national processes alone. Some level of organized planning or coordinated policy promotion at international financial and institutional levels shape these outcomes, not necessarily through a single unified plan with explicit goals, but through the consistent promotion of particular economic frameworks by international institutions, through the training of economists and policymakers in similar models at similar institutions, through the circulation of policy templates across national governments by advisory networks with consistent orientations. This interpretation is the most contested. Its critics argue that it overstates the degree of coordination and underestimates the role of genuinely independent processes producing similar results. Its supporters point to the documented influence of specific international institutions over national economic policy, particularly in countries that required financial assistance during economic crises. They note that the policy conditions attached to international financial support were remarkably consistent across different countries and different crises, and that those conditions consistently moved in directions that affected labor markets and financial obligations in similar ways. None of these four interpretations has been conclusively proved. Each faces genuine challenges and has serious critics. The political failure view struggles to explain cross-national convergence. The corporate power view explains wages better than it explains costs. The financial system view requires accepting a structural claim that many economists dispute. The coordination view relies on evidence that is suggestive but not definitive. What this range of incomplete but serious explanations suggests is not that the truth is unknowable. It suggests that the truth is layered, that multiple forces operated simultaneously, each contributing to the overall pattern, none of them alone sufficient to explain it completely. What all four interpretations share, and this is perhaps the most important observation, is a rejection of the official baseline explanation. The view that what happened to working family finances over the past century was simply the natural and neutral result of market forces operating without design or direction. Each of the alternative interpretations, in its own way and from its own analytical foundation, concludes that this baseline explanation is insufficient. The consistency of outcomes, the direction of change, the timing of developments, and the distribution of who benefited and who bore the costs all point towards something more specific than natural economic development. Some believe the answer lies in political reform, others in labor market restructuring, others in fundamental changes to financial architecture, others in greater transparency about international policy coordination. These are genuinely different proposed responses, reflecting genuinely different diagnoses, but the shared starting point, the shared acknowledgement that the official explanation does not fully account for what happened, is itself significant. It means the question remains open. It means the investigation is not finished. And it means that whatever the complete answer turns out to be, it will likely be more complex, more specific, and more uncomfortable than the standard account has so far been willing to acknowledge. Every investigation reaches a point where the evidence has been laid out, where the pattern has been traced across its full visible length, where the questions have been asked carefully and the available answers have been examined honestly, and where the honest conclusion, the only genuinely honest conclusion, is that the picture is clearer than it was at the beginning, but not yet complete, not yet resolved, not yet reduced to a single explanation that accounts for everything and leaves nothing important unaddressed. This investigation has reached that point. So where does it actually leave us? What has been established and what has not? These are worth separating carefully, because there's a difference between what is documented and what is explained, between what is measurable and what is understood. And that difference, in this case, is significant enough that collapsing it would misrepresent what the evidence actually shows. What is documented is substantial. The paycheck exists. The deductions exist. The gap between what workers earn and what reaches their daily lives is real and measurable. It is not a theory. It is not an impression. It shows up in wage records, in tax data, in household financial surveys, in the accumulated experience of families across multiple generations and multiple countries. When a worker earns a wage and then navigates through deductions, obligations, insurance costs, housing payments, debt repayments, and rising costs in education and healthcare, the distance between the starting number and what remains for ordinary life is not imagined. It is arithmetically present, and it has been growing. The obligations are real. Each category of deduction and cost that has been examined across these chapters exists in the actual financial lives of actual families. None of it was invented for this investigation. The withholding of taxes before wages arrive, the expansion of income taxation from a narrow measure affecting the wealthy to a broad system touching almost every worker, the divergence between productivity and wages beginning in the 1970s, the simultaneous expansion of consumer debt, the rising costs of housing, education, and healthcare that now require debt as the standard mechanism rather than the exceptional one. All of this is in the record. All of it is verifiable. What remains unclear is the why. And this is not a small remaining gap. It is the central question. The documented pattern is clear in its direction. The explanation for that direction is not. The simplest available explanation is natural development. Complex economies evolve. As they grow, they develop more elaborate systems, more institutions, more obligations, more mechanisms for distributing costs and risks across populations. The expansion of financial obligations on working families, in this view, is simply what happens when societies modernize and their economic systems become more sophisticated. Nobody designed it. Nobody coordinated it. It emerged from the accumulated decisions of many actors operating independently within systems that were themselves evolving. The consistency of outcomes across different countries reflects the shared pressures of integrated global markets rather than any common design. This explanation has real appeal. It is modest in its claims. It does not require assuming any level of coordination that would be difficult to organize or maintain. It treats the pattern as the result of many independent causes rather than a single directing hand. And it is probably partially correct. Some portion of what happened to working family finances over the past century is genuinely the result of complex systems evolving in ways that nobody fully anticipated or controlled. But at first, this explanation seems sufficient, and then the problem appears. Because natural development, operating independently across different countries, with different systems, does not reliably produce outcomes that are this consistent in their direction. Markets are not simple. They produce varied outcomes. Different policy environments produce different results in many domains. And yet in the specific domain of working family financial pressure, the relationship between wages, obligations, and actual living standards, the direction of change has been remarkably uniform across remarkably different contexts. Natural development alone struggles to account for that uniformity. The second available explanation is policy failure. Governments made poor choices. Democratic systems were influenced disproportionately by those with the most resources to spend on influence. The interests of ordinary workers were underrepresented in the rooms where consequential decisions were made. And the accumulated result of those skewed decisions was a policy environment that consistently favored capital over labor, financial institutions over borrowing families, and efficiency of revenue collection over transparency of financial obligation. This explanation is hopeful in one sense. It implies that better policy, achieved through more genuinely representative democratic processes, could produce better outcomes. But this is where it becomes unclear again. Because policy failure in individual countries does not fully explain why the failures were so consistent across different political systems. Countries with stronger labor protections, more robust public services, and governments more explicitly oriented toward worker interests still experienced broadly similar trends in the relationship between wages, costs, and family financial pressure. The degree varied, the specific mechanisms differed, but the direction was similar. And if genuinely different policy environments produced similar directional outcomes, the explanation that better policy within individual countries would fully resolve the pattern becomes harder to accept with confidence. There is also a more uncomfortable question embedded in the policy failure explanation. If the failures were recognizable, if researchers and analysts could document what was happening to working family finances, why were corrections so difficult to sustain? Policies were enacted in various countries at various times that were intended to rebalance the relationship between wages and obligations. Some produced real improvements in specific areas, but the overall direction of the pattern proved remarkably resistant to reversal. This is worth sitting with, not because it proves any particular explanation, but because a pattern that persists through multiple attempts at correction across different political environments is a pattern whose roots may be deeper than policy alone can reach. The third possibility is the most difficult to state precisely and the most uncomfortable to consider. That something more organized operated behind these changes, not necessarily a single unified plan with explicit goals and a central coordinating authority, but some degree of consistent intention expressed through international institutions, through the promotion of specific economic frameworks, through the cultivation of particular policy orientations across national governments, that shaped outcomes and directions that consistently served specific interests at the expense of working families. This explanation does not require imagining a secret room where everything was decided. It requires only that institutions and networks with consistent interests consistently promoted frameworks that served those interests, and that those frameworks were implemented widely enough and consistently enough to produce the pattern that the evidence shows. And this is where the explanation becomes most difficult to evaluate, because the evidence for this possibility is real but indirect. The documented influence of international financial institutions over national policy during economic crises is verifiable. The consistent orientation of policy advice from major economic bodies toward frameworks that prioritize financial stability and market flexibility over wage growth and worker protection is observable. The career networks connecting government, financial institutions, and international bodies show consistent patterns, but none of this constitutes definitive proof of intentional coordination toward specific outcomes for working families. It is suggestive. It raises questions. It does not close them. What is perhaps most striking, when all three explanations are held together, is not their differences, but their shared implication. Each of them, natural development, policy failure, and organized intention, acknowledges that something real happened, that the relationship between work and financial security shifted in ways that were not inevitable, not fully explained by the forces officially cited, and not adequately accounted for by the standard narrative of economic progress. They disagree about the cause. They agree that the cause was more specific than simply markets doing what markets do. Something changed. This is the point of clearest agreement across all the evidence examined. Something shifted the basic architecture of how working families relate to their earnings, their obligations, and their financial futures. The shift happened gradually enough that no single generation experienced it as a sudden disruption. It happened through channels legitimate enough that questioning it felt unusual, and it settled into a new normal so thoroughly that most people today do not think of it as a condition requiring explanation, only as the way things are. But the way things are was not always the way things were. And the distance between those two realities, between the relationship between work and financial security that existed in earlier decades and the one that exists now, is large enough and consistent enough across different countries and different systems that it deserves more explanation than it has received. The question of what produced that distance is not closed. It cannot be honestly closed with the evidence currently available and the explanations currently offered. Natural development, policy failure, and organized intention each explain something real. None explains everything, and the space between what each explains and what the full pattern requires explained is where the most important questions still live. What that space contains, what actually accounts for the full consistency, the full scale, and the full direction of what happened to family finances over the past century, is not yet answered, not by official sources, not by the alternative analyses examined here, not by the evidence as it currently stands. Perhaps the most accurate thing that can be said, after tracing this pattern as carefully and honestly as the available evidence allows, is this: the investigation is not finished. The documented reality is clear. The explanation for that reality is not. And the gap between those two things, between what is known and what is understood, is not a small technical detail waiting to be tidied up. It is the center of the question. And perhaps that is exactly where the real investigation begins. Not at the point where answers are given, but at the point where the questions become clear enough, specific enough, and honest enough to actually pursue. That point has been reached. What comes next depends on whether the questions are taken seriously enough to follow wherever they lead.